Alright guys, back with another video. So this one, I don't know how long it's going to be. I might ramble on a little bit here. I did a live stream earlier a couple hours ago, and I don't know. I'm just gonna delete it because I was not doing my own content. I was just live streaming other people's content, and I don't know. I'm sure YouTube going to flag it at one point. So that's why I deleted it. And of course, like, you didn't miss anything. I was just babbling. But anyway, Merry Christmas to everybody. And this one, I was watching this particular, documentary. Well, it's only 18 minutes long, but it's a segment about private equity, right? And of course, we know, if you watch Moran's, you know that angle already. But this is more of a summary of what happened to companies in America at this time, right? And of course, this is Wework right here. I've did a video about that before, and my angle is that the media has been pushing this for a long time, that this company is the tech company and all that stuff, and it has this excitement around it, right? And when they promote it to you, there's a lot of kind of hyped, right? But I found this video here. Now I use CNBC a lot because, like, to me it's clear on what they're kind of doing to the public. And now this one is like 4 years ago. Now 4 years previously, when this guy right here, now this is a SoftBank. Oops, sorry. Yeah, sorry. I'm just gonna continue anyway. So this guy is the CEO, the founder, who kind of brought Wework to the forefront, right? So what it is, it's just a way for you to rent out office space, right? And they have this amazing, grandiose, working space that is not like really technically the traditional working environment, right? So the idea is that this company could rent this space out for the employee to enjoy working together in a open setting type thing, right? So to promote employee wellness, so to speak. But essentially what the company is just renting those space out. So it's a real estate company, but when it was pushed out to the public, when it was IPO'd or whatever, after this deal that they did with SoftBank. Now I'm not going to go into detail, but they were pushing out as if like it's a tech company. And that's why the evaluation, it went from, $40 million to whatever, after this deal, SoftBank bring it to a IPO at $9 billion valuation. Now, of course, like, I couldn't, hold on, let me see if I see any, I think annually right there. So in 5 years, this company went from, hold on, let me see right there. So went from $500 a share down to now 50 cents, right? Of course, it's already filed for bankruptcy already a couple months ago. So yeah, that's why the price kind of cradled. But my point is that it was evaluated like right here, IPO'd right before the run for GameStop, right? Remember, GameStop was here. Now, I know, like, I relate everything to GameStop, but the time frame is kind of curious to me, right? Why it was IPO then, and it was pumped to the public as if it's something great here. Now, this one is 4 years ago, so 19. I'm sure it's already in the work that they were going to push it out, but the time frame for GameStop is a little bit different. But my point in this is that before this, they were negative about it. CNBC, 4 years ago, Wework was, the ridiculous company that was, doing deals with the previous CEO and all that stuff, right? And highly indebted, It was a ridiculous deal, to say the least. Well, let's listen in a little bit here. I'm going to speed it up for a minute because so let's listen in to the and note the reporter here too.
Up his loan. He has a $500 million loan that was coming due. They're going to give him a new loan. They're also going to give him a quote-unquote consulting contract of almost $200 million.
Maureen, why are Wework shareholders and employees not going to sue Adam Neumann and sue SoftBank for a deal that clearly advantages him in a way that, even with his controlling stake, is a very questionable approach?
I think it's far too early to say what happened. I think that the issue, it seemed like during the negotiations, was that he had the power. He had this voting control, so they needed to find some way to get him to relinquish that. Our understanding is that consulting contract was one part of it, the loan forgiveness. But I think it's a good question. It seems like,
it's a terrible look on a week that they're going to fire 2,000 people to be taking a $185 million consulting arrangement. I can understand potential.
$125 million for consulting. Like, all it is just consulting fee right there. So, this company has been wasting money and all that stuff. Yeah, at that time, CNBC was very negative about it, which is, their rights to be, right? But curiously, though, when... so this is, again, 4 years ago. Let's listen in.
Exclusives with Wework, or should I say the We Company, co-founder and CEO Adam Neumann, as well as strategic partner, who else but actor Ashton Kutcher. She joins us now from LA with the highlights. Hey, Deirdre.
Hey, and that's another thing too. So they use these actor and actresses to, entice people to invest in the company. And this is so that you buy it at a high valuation and hold it for them. And they sell it to you at that price. Remember, they got it, before the IPO. Like pennies on the dollar. But then when they sell to you, it's like evaluated at, I wouldn't say for pennies, but the share they didn't buy it at $392 a share. I could assure you that. That's why IPO, it's like a scam. It's almost, right? So let's listen in.
Again, now we rarely hear from Neumann or Kutcher. And remember that Kutcher is an investor in some of the oldest and biggest unicorns, Airbnb and Uber. So we really wanted to get their thoughts on companies staying private for longer or taking a company public in this environment.
The young CEOs of today are afraid of going public. I think two things change. One, there's never been access to private capital like this. So I'm not sure if we would see some of the largest companies in the world today. If they were starting today, I'm not sure you would see them going public as soon as they did. They had no other choice. Most companies in the world run their company with quarterly earning reports. And when I'm going to make a decision, this is true about life and true about a business. When I'm going to make a decision based on 3 months forward, I'm not going to make the right decision. Masa is very famous for making a 300-year plan. If you want to start thinking forward, you really have to think really far away.
Now, Neumann said that when his company, now called the We Company, does go public eventually, and he says that they are ready, he's going to be looking to public company CEOs like Jeff Bezos and Mark Benioff, who, despite the quarterly grind, are able to retain and continue to focus on their long-term vision. Now, another investor focused on the long-term is SoftBank's Masa-san. We asked Ashton Kutcher how Masa's strategy has changed the outlook for VC funding as well as for startups. Have a listen.
The minute that you start having to report publicly, you have to start playing games with your numbers, you have to start playing games with your growth, and usually the person that loses in that situation is the consumer. So if we're trying to create extraordinary experiences for consumers over time, the longer those companies can stay private, and by Masa coming in and enabling that, the more unbelievable the experience and more life-changing the experience will be for people. Now, I'm also on the other side of the table with Masa on a couple deals.
Okay, yeah.
And that's frustrating as hell.
Very frustrating
but what am I going to do, get upset at the game? Like, no, I've just got to figure out how to out-hustle and win.
Yeah, out hustle. And then who's going to lose? Shareholders. Again, this type of game is being played not in, your best interest in mind. When they put this type of company out on an IPO stage, it's already, bad for you already, whoever investing in afterwards. So again, the company's growth is not going to be at the IPO stage. IPO is there to take more money out of the public. And yeah, if you could make money, I'm not saying you won't be able to make money, but if you sell it at the onset of this company, right? Or you better make sure that the company that you're working for has the leadership that has, shareholder in mind here, every shareholder. So, and not just, doing these backdoor deals with the banks and, CEOs among themselves and screw over shareholder like the common shareholder, like you and I. So again, so this is 4 years ago, and it was like a big deal, right, at the time. But then, after that deal happened, SoftBank kind of pushed out the previous CEO out. So now, 2 years later, so if you look at the time frame right here, March 27, no, sorry, can't even read. March 26, okay. Now, if you look at the date right here, March 26, 2021, okay? Remember that date, March 26, 2021. Okay, 2021, man. Right here, at the top of the market, okay? So, maybe a little bit less than that. So, around here. So, let's say the share price was $500, okay? When at the time of this particular video. And let's listen in how the sentiment of that particular segment about WeWork was.
WeWork announcing it has agreed to go public via SPAC merger with Boex Acquisition Corp. That values the company at $9 billion, including debt. CEO Sandeep Mathrani was on Squawk earlier today discussing that deal.
We were approached by Boex and other SPACs. We looked at our plan. We'd seen what we'd accomplished in 2020, and we'd seen a path to profitability. And we thought it was a good time to raise additional liquidity, to de-risk the balance sheet, and to make sure that we had a path to profitability. So sometimes, the path picks you. You don't pick the path.
Oh, boy, this is ripe for us, Jim. I mean, $9 billion, including the debt, versus a valuation of $47 billion back in 19. Boex, we should also let you know, is run by Vivek Ranadive. He's the owner of the...
Sorry. So they went public at $9 billion with debt, okay? How much debt? Well, let's look at it. So this is a previous, so at IPO around here. So at IPO, but this is when the restructuring happened, right? 21 right here. This is when they were doing the restructuring and all that stuff. And look at the balance sheets here. Again, and this is IPO'd. It shouldn't happen that way, and the regulator should be more astute to this. That when you have a company that doesn't make any money at all, you shouldn't be able to go to the public and say, hey, buy into this. It's terrible for the markets to be this way. And, say, oh, allow people to make money. Well, I think the law back in, like 40 years ago, I'm sure there's some rules and regulation as to who qualifies to IPO. And that I think you have to have a profitable quarter for at least 5 quarters in order for you to IPO to the public. Now, you don't have that at all. It's like any company at all could go IPO and go straight to the public to scam them, right? So let's look at this. And again, I'll finish that segment in a minute. If you look at the balance sheets right here, trailing 12, of course, goodwill value to the tilt. What I'm interested in is this one right here. Oh, man. Right there. So at IPO, during that segment, they were... They went public at $9 billion valuation while having $22 billion in debt. Okay, let me say it again. $22 billion in debt, IPO at $9 billion. Okay, so if you look at the shareholder equity at that time, you see how ridiculous this is? $9 billion in the negative, and they still push it to the public. Ridiculous. But let me listen to this guy. I'm sure you know what direction that is.
The Sacramento Kings. this is more interesting than the Kings, I guess, lately.
No kidding. I'll tell you what's really compelling about this. And it's Barry Sternlicht's quote. I happen to be a big fan. Barry it got a bit of a Midas touch.
He's in the pipe.
Yeah, and he is saying WeWork is the leader in flexible space. Well, what do we need more than anything else? Who knows who's coming back and who's not? Is there a way we can get some flexible space? Well, WeWork has it. So it's kind of like, it's just as it wasn't the company we needed a year ago. It is the company we need now. I have to tell you, I have been very critical of recently a lot of SPACs. I'm not critical about this one.
Oh, of course you're not critical about this one because you want people to lose money, Jim. I mean, I don't think you care at all. And the fact that people like this has the platform to mislead so many people, and yet nothing happened to this guy. But when people are trying to, steer people the right way, oh, they're scammers, oh, they're just conspiracy theorists, oh, they're whatever. The biggest company out there that has the ability to do anything like this is GameStop. But again, it's a very small thing, right? It's slow growth, brick by brick, and slow growth can add up in over decades on end. And so people like this will push this type of company to you because you are only thinking about the short-term gain here, right? While the company was $22 billion in debt and the shareholder equity was negative $9 billion. There you go. This guy is telling you to buy into it.
But plus, there's a lot of heavyweights involved.
Yeah, Fidelity. There's Sternlicht, as you said, who, by the way, he made headlines on Squawk earlier in the week when he was talking about the SPAC market being, quote, out of control.
The bucket shops
in some places. I know you guys, you and David obviously talked a lot about that. You do need people to return to the office. I'm also thinking about, sure, on the surface it sounds perfect, right? The timing's perfect.
Right.
Temp space. But what about existing leases that are already in place from some corporations in big cities?
Oh, it's perfect timing, right? Of course it's perfect timing. It's, again, these are type of the sentiment that they want you to think about this particular company, even though it's in debt. It doesn't matter for them, and you have to understand that these type of figurehead right here with the suit and ties and all that stuff, they do this very often. And it's very clear to me that, a certain company they don't want you to get into because, again, it's too cheap for them. Cheap for us, right? Like it's, for example, what does Jim Cramer says about GameStop? Buy it. Sell it. Don't hold it, right? But he wants you to hold this company. And we all know what happened to this company right now. And again, this is 2 years ago. 2 years ago. And it's a perfect company for you to buy, right? According to Jim Cramer. Now, so that's all I have for this one. I feel like that's the gist of it, right? So go ahead and watch this particular segment right here. I'll link it down below. Again, it's talking about private equity and all that stuff and how they are kind of what Morantz is saying in his Connect the Dots series. But if you want to do just know about the gist of it, this particular video is a very good one. Short, sweet, and to the point there. So, alright. So that's all I have for this one. We'll see you later. Merry Christmas. Bye.